Aloha, I'm Colin Moore, and I'd like to welcome you to another episode of UHERO Focus. Today we'll be reviewing UHERO's forecast report for the second quarter of 2022 with two UHERO economists, Peter Fuleky and Stephen Bond-Smith. Thanks for joining me. Peter, let me start with you. What's the global picture and how does it affect Hawaii?
So, prospects for US and global economic growth have worsened quite a bit since our March forecast for several reasons. The Russian war on Ukraine pushed up energy and other commodity prices. Supply chains are once again threatened by wide-ranging shutdowns in China as the country tries to enforce its zero-COVID policy. Inflation is now the highest in decades. The Fed is signaling a rapid pace of monetary tightening, and mortgage rates are already up by 2 percentage points since the end of last year. These factors will significantly restrain growth for the next several years and raise downside risks. On the one hand, at the national level, we just learned that US gross domestic product declined at a 1.4% annual rate in the first quarter, although the most important fundamentals such as consumer spending, business investment, and the number of jobs continued to grow. On the other hand, in Hawaii, the UHERO pulse turned up in late January and has risen nearly 20 points by mid-April to its highest level since the pandemic began. But the macroeconomic landscape is quite volatile, and the risk of a recession is much greater today than it was when we prepared our first quarter forecast.
Stephen, inflation is a concern for everyone at the moment. What's causing this inflation surge?
Yeah, so last year's inflation surge has become stronger and more persistent than expected. It's caused by the combination of strong demand and supply chain bottlenecks or shortages. The demand side factors are temporary. The reduction in dining, entertainment, recreation, and other service activities during the pandemic led to a shift in demand to physical goods, leading to shortages and backlogs. Eventually, a more normal pattern of consumer spending will ease. Some of this pressure and the end of fiscal support, as well as rising interest rates, will tend to reduce overall spending. Now, some supply challenges may last a bit longer, such as high commodity prices, and there are key industries where supply constraints remain very important. For example, vehicles and other sectors using semiconductor chips. Inflation is going to eat into people's spending. Their budget isn't going to go as far when they face price rises, and so inflation will reduce demand and create headwinds for the economy.
So, Stephen, how are policymakers responding to these inflation challenges?
So the Federal Reserve is raising interest rates quite aggressively, which even includes larger half-point increases. The Fed Chair Jerome Powell is signaling a strong willingness to tackle inflation. We think the federal funds rate will peak at about 3.25%, just a bit lower than the market suggests. Winding back, the Fed's large balance sheet will also put upward pressure on mortgage rates, which have already surged by more than 2% since last summer for a 30-year mortgage.
Peter, Hawaii tourism was hit so hard by the pandemic. How has it recovered, and what's the outlook for tourism here?
Yeah, the Omicron wave put the brakes on Hawaii's tourism industry at the start of the year, but the number of cases dropped faster than in earlier waves, and Hawaii's tourism industry quickly resumed its recovery. In fact, the total number of deplaning passengers this April was almost the same as in 2019. The North American market is particularly strong. Since the end of the Safe Travels program, there are no more COVID requirements for domestic passengers, and US arrivals are higher than before the pandemic. The number of Canadian visitors has also taken off. It has recovered to about half of the pre-pandemic level. Outside North America, travel was hindered by recent COVID waves, for example in Australia and South Korea. Japanese arrivals continue to be suppressed by a daily cap of only 10,000 inbound passengers into the country, which is less than 1/10 of the pre-pandemic traffic. Another concern is the 20% decline in the value of the yen, which will make travel more expensive for Japanese visitors. The cost of travel has also increased. At the national level, airfares are back to the pre-pandemic level, and car rentals are up more than 50%. Hotel room rates in Hawaii are up about 20% compared to 2019. Despite these challenges, we remain optimistic about prospects for the visitor industry. The North American visitor markets will remain strong due to remaining pent-up demand and relatively strong economic fundamentals. The recovery of Japanese arrivals will begin later this spring as travel restrictions are eased, And as COVID-19 falls back throughout the region, visitors from other international markets will start to arrive in larger numbers during the next 2 quarters.
Stephen, what's the overall outlook for Hawaii's economy?
So the state's labor force took a hit during the pandemic. While the recovery hit pause during the Delta and Omicron waves, the labor market's begun to edge up again. While the share of people employed or looking for work has now largely recovered, the population has declined, mostly on Oahu, meaning the number of available workers is now below its 2019 level. This will constrain future growth, but the job count will still rise by more than 4% this year, with continuing growth in 2023. Now, incomes were protected during the pandemic by the support from government, but the end of this support means that incomes have now taken a hit. Along with inflation, this means that real income will fall by 5% this year and recover less than 1% in 2023. Employment gains and a tight labor market will support a return to higher income growth by 2024. Hawaii's real GDP will rise by 3.5% this year and approach its pre-COVID peak by the middle of 2024.
Stephen and Peter, I appreciate your insights. Thanks so much for joining us for this episode of UHERO Focus.